Now let's practice the adjustment journal entry. One of adjustment entry for the depreciation based on the full disclosure principle. Yeah, depreciation is the when the company uses the 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 PP&E, property and plant equipment, for each year, each year over its useful life. So it shows a decline in usefulness. And then this depreciation expense on the income statement, it is now the accumulated in the accumulated depreciation account on the balance sheet. And then accumulated depreciation is a contra account that reduces a value of the company account, which is the PP&E. So as you can see that the adjustment entry is recorded. Once the company uses this PP&E, depreciation expense on the debit side and then accumulated depreciation on the credit side. Because this accumulated depreciation reduce the asset, which is the company account, the PP&E. And then depreciation on the debit, that is the income statement account that reduces the equity. So on the balance sheet, it shows the PP&E minus accumulated depreciation. Minus accumulated depreciation, or the sum of depreciation expense over the years, because the balance sheet is the accumulation concept. But the income statement, on the income statement is this 1 year, the uses, the expense of this PP&E. So it shows only 1 year depreciation expense in the operating expenses. Okay, so let's practice in Excel. Transaction occurs now January 1st, issued common stock. It's very easy now. When the company issued common stock, so the company sold the shares by receiving $10,000 and they issue the common stock. Common stock 10,000. Then using this cash, the company purchased a machine with 5 years useful life. Oh, this machine has 5 years useful life, and then straight line depreciation will be applied. And then it is purchased on credit. So how do we record? Now machine $1,000 value, and then accounts payable because it's on credit transaction. So $1,000 purchased on credit. Then adjustment. April 15th, the company paid $1,000 to the supplier. So how do you record, right? So once the company paid cash, this liability should be reduced. So cash should be reduced. Cash reduced, and then liability, the cash down, the asset down, and liability down. And then 1 year after the company purchased, so it should be recording the depreciation expense for the machine. So how do you record? Right, on the credit and debit, let's start from there. Depreciation expense. Depreciation expense. Once the company uses this machine original cost is not reduced directly, because based on the historical cost principle, this machine $1,000 should be remaining there to give information to the investors. Depreciation expense, how much is that? $200. How do you get it? 1,000 divided by just 5 years, so 200. And then on the debit and credit, it should be recorded the accumulated depreciation. So this $200 depreciation should be recorded on the accumulated depreciation, so that the machine net value should be reduced by the 200. Accumulate depreciation is a contra account that reduces the asset. That's why it shows on the credit side. So once we recorded all this transaction, now let's collect the cash on debit and cash on credit. So we got the cash balance 9,000. A machine value $1,000. Oh, don't put machine on here because this $1,000 history cost will never be affected. But accumulate depreciation of machine 200. Now should be recorded on the contra account that reduces this machine. Accounts payable is the liability account. Now paid out 1,000, so there's no accounts payable at all. Depreciation expense is the debit account that reduces the equity. The depreciation is the one of operating expense account on the income statement. So depreciation 200 on the debit. And then common stock is equity account when the company issued. Okay, let's make sure that the company collect all the journal entry on the T account. So the cash and the credit and the machine, accumulate depreciation 200 and accounts payable 1,000 and accounts payable 1,000. There we go. And then depreciation expense on the debit side and the common stock on the credit. So 12, the sum of debit, sum of all the credit is 12,200 balanced out. Once we made sure that the balance debit and credit balanced out, let's collect the balance. Now that is the point. Machine 1,000. Now I put the negative because this accumulated depreciation is contra account that reduce the machine. So on the credit, so minus 200. So machine net value is now reduced by 200 because the company had used the machine for the year. So the useful life of 5 years. Now the remaining value is 4 years value 800. So it's matched. Okay. So total asset is 9,000 cash and machine 800. Okay, then let's get accounts payable, zero value, common stock, 10,000. And then let's collect the income statement account. We don't have the sales, we don't have the cost of goods sold, so the gross profit is 0. But okay, there you go. The depreciation expense 200, that is that minus on the income statement. So 200 minus, so operating income, there's no other the expenses. Then 200 minus 200 is net income. So it should be recorded on the retained earning. Then we balanced out between total asset and liability plus equity with 9,800. Okay, this is it. Now let's move on to the deferral for the next video clip. See you guys. Bye bye.